Hey, good morning, good afternoon, everyone. Welcome to the webinar. I'll kick things off in 1 minute. Welcome, everybody, to the webinar today. NFTs, a nascent investable asset class with 10x potential. And I believe we're still a very early stage, early innings on NFTs. It's been an asset class that really just came to fruition in its current form basically a year ago. It traces its roots back to 2017. But as we'll see in this presentation, we didn't see the liquidity implying that it's an accessible asset class until Q3 of last year. So you can measure the age of this asset class in months, not years, which is why I'm super excited about it. I think there's a ton of upside potential. Obviously, it's highly volatile, very risky, but NFTs as an asset class is something that I believe will be a default in investor portfolios in 10 to 20 years. But right now, it's the opportunity to get in really the ground floor. And I believe Accelerate is one of the only, or if not the only, institutional investor beginning to allocate to this asset class. So we're super keen on it. One key stat that I want to share that really outlines the importance of the diversification benefit of NFTs as an asset class. And I came across this statistic a couple days ago. In year-to-date 2022, speculative assets have drawn down significantly, whether they're cryptocurrencies. The NASDAQ is in a bear market, down 20%. What is astounding is that NFTs, people assume that they'd be highly correlated, but in fact, it's quite the opposite. In 2022, broad-based portfolio of NFTs is up 90% in Ethereum terms and 35% in US dollar terms. Just shows you the extent of the diversification benefits of this alternative asset class. And the definition of an alternative asset class is an asset that is driven by different economic factors. And that's what we're seeing within NFTs. And as an investor, that's a thing that we look at in terms of how do we diversify portfolios. It's finding uncorrelated asset classes with high potential returns. And I believe that's what we've discovered with NFTs. So let's get into the presentation today. I have a quick disclaimer, if you could take a read through that, and then we'll kick things off. Just a brief introduction to Accelerate. So we're, I think, one of the most innovative and fastest growing alternative investment solution providers out there. So I started Accelerate with the mission of democratizing alternative investments. I started out managing hedge funds for high net worth investors, institutional investors, and I went through 2008, 2009, the great financial crisis. And we generated great returns for investors, both positive in 08 and 09. And of course, they were very happy, the wealthy individuals and institutional investors I managed capital for. But people would ask me what I do for a living. And back then I'd say, well, I make rich people richer. And that never sat well with me. My mission has always been to be the people that need alternative investment solutions the most out of anyone is those that cannot afford to lose money. if someone is worth $50 million and their portfolio gets cut in half to $25 million, they're still going to be just as wealthy as they were in the spirit. But if someone has $500,000 and they lose half their nest egg to $250,000, they may have to keep working for 10 years. So my job is to bring the strategies that were previously only accessible to the Yale Endowment, other institutions, and wealthy family offices. I want to bring that to everyone with no minimum investment, easy to use, and like I said, democratizing alternative investment solutions, leveling the playing field such that everyone has access to these investment strategies. So we do that through a number of methods. We offer hedge fund ETFs. We have 5 in the market currently. 4 hedge fund ETFs. We have crypto ETF, more to come. We're launching a DeFi fund, which I'm excited to chat about, and we offer managed accounts. So quick overview of Accelerate. Now let's chat about NFTs, the metaverse, and Web3. So I'm sure many of you have heard the terminology, brand new terminology, Web3. So what is this Web3 everyone is talking about? Well, Web3 represents the next era of the internet. What this refers to is massive, global, decentralized networks that are driven by tokens on blockchains. And that's where NFTs lie. That is the basis of Web3, is that Web3 will be owned by the token holders, not massive multinational conglomerates. So imagine Facebook right now, Mark Zuckerberg and some venture capitalists own hundreds of billions of dollars of stock in Facebook, and the users of it gain no value, no monetary value at all. The users are the product. If Facebook was a Web3 version, the owners of Facebook would be the token holders, and the token holders would earn the revenue generated by the network. So that's how you can envision Web3, are these massive networks that are owned by the token holders, not corporations, and the value accrues to the token holders, not the corporations, which is a beautiful thing to see. So NFTs stand for non-fungible tokens. These allow users not to just participate, but own Web3. I do see some investment products saying, oh, they're Web3, or here's a metaverse ETF, but you're not going to make money off the metaverse and Web3 by owning equities. That's not the way to play it. The way to play Web3, if you're a believer in its growth, is through NFTs. NFTs are the pure play way to gain exposure to Web3 and the metaverse. And in my opinion, the most popular and globally recognized liquid NFT collections may become the next Googles, the next Amazons, the next Facebooks of Web3, and that's what we're here to chat about today. So let's get into NFTs, these non-fungible tokens. Now, I'm sure you've seen these pop up in the media. You got the CryptoPunks, you got the Bored Apes. There's literally thousands, if not tens of thousands, of NFT collections out there. But if we break down what an NFT is, it's a crypto asset combining a number of unique elements. And so I'm a fan of the quote, I believe it was said by Mark Twain. Potentially that's his rumor, but he said, history never repeats, but it sure does rhyme. So NFTs are a brand new asset class that is basically unprecedented. However, we can take elements from other historical asset classes and blend them together to get a sense of what NFTs as an asset class represent. So they represent elements of blockchain, social networks. They derive value from aesthetic, social proof, membership, network benefits, rarity, culture, liquidity. There's all these different value drivers that we see coming from other asset classes that have been emerging within NFTs, and that's a key aspect of my presentation today. Many people say, oh, it's just a picture of a monkey. I can just save as, right-click, save as for free, and get it for free. Why are people paying $500,000 for this? So I'm going to get into why NFTs have value, which is the key aspect of this webinar. And it's really, there's a lot of misunderstanding, misinformation, and somewhat of blissful ignorance that I would like to inform investors of the tremendous economic value in buying NFTs. So NFTs, they represent a new cultural phenomenon and a new emerging asset class that I think has tremendous upside potential in the future. So what makes NFTs valuable? In my opinion, there are three key value drivers that I want to really dive in today. And one thing I forgot to mention, if you guys have any questions, put them in the chat and I'll get to questions at the end of the webinar. So this part is key and I want to really dive deep into the details here. So three value drivers. Number one, aesthetics, rarity, and prominence. Number two, income generating potential and utility. Number three, social proof, membership, and credibility. Now, each one of these value drivers we have seen in other assets that already exist. So the mental model or the framework for envisioning NFT valuation and why they're an investable asset class, we can blend elements of other asset classes, other historical investments into a new mental model, a new framework to envision where the value lies. So I want to dive deep on these three key value drivers. So the first being aesthetics, rarity, and prominence. So here, the best analogy is art and collectibles. Now, this has been an asset class. Physical art and collectibles has been an asset class for perhaps over 1,000 years, certainly many, many more hundreds of years than equities have. So it is an asset class that, while speculative in nature, has cemented itself as perhaps, the first or second asset class, perhaps second next to precious metals, that human beings derive value from. So take, for example, I posted a couple pictures here. The one on the right being a Mickey Mantle rookie card, which just sold for over $5 million. So if we boil down what a Mickey Mantle rookie card is, it's some ink printed on a piece of cardboard. If you say, oh, here's ink printed on cardboard, is this worth 5 million? I'd say, no, that's worth 0, right? And the person who opened this bubblegum pack 70 years ago and got a Mickey Mantle rookie card, maybe they paid 5 cents for the pack of gum. Would they have ever envisioned this to be worth $5 million? No. But the fact of the matter is that we all acknowledge, especially for us collectors who had sports cards as a kid, hockey cards, baseball cards, etc., we recognize that these now have value. Like, we got to admit that a Wayne Gretzky rookie card is worth millions of dollars. That's just where buyers and sellers transact in a relatively liquid, transparent market. Now, art, this has been an asset class that has been around for over 1,000 years. Many are viewed as worth tens of millions or even hundreds of millions of dollars. Here is a recent sale of Botticelli's Portrait of Jesus, sold for nearly $50 million, so $45 million for just some ink on a canvas. That's how some skeptical people would look at it, but investors, allocators, collectors would recognize this is a historical piece that's rare, has great aesthetics, and it does have prominence. So to solidify one thing, art and collectibles have been around for decades, if not hundreds of thousands of years. Art and collectibles are now moving from the physical to the digital realm. We have seen that transition within other media over the past couple decades. We have seen film move from physical to digital. That's why Blockbuster went out of business and why Netflix now dominates. It's why CD-ROM or CD manufacturers went out of business, and Spotify, iTunes now dominate. So humans prefer digital media over physical, and art and collectibles will be no different, which is why NFTs have so much upside potential, because one day they will be multiples of the physical art and collectibles market, which is in the hundreds of billions of dollars. The other thing is that NFTs solve a number of problems that exist currently in the physical art market. Number one is authenticity. Even the most expensive artwork ever sold in the world, Da Vinci's, I believe it was Salvator Mundi, painting sold for $400 million. And there's a lot of controversy around that because some people think it's fake. Now with NFTs, you're guaranteed via the mathematically verified blockchain that you're buying an authentic work. So NFTs solve the authenticity issue. The other is security. So we can secure our NFTs in cold wallets, cold storage. And what I do, I print off my NFTs and hang them in the office, hang them around the house. And that print costs less than $100. Do I have to worry about having security for displaying my artwork? No. But if I owned a $1 million physical artwork, would I be worried about the security? Yes. So NFTs do have some superior characteristics than art and collectibles historically. One is authenticity. Number two is security. But the third and most important is liquidity. Some of these NFT collections trade millions of dollars per day. And as investors, we all know the illiquidity premium, i.e. illiquid assets tend to be worth less because you have less liquidity. So as an asset becomes liquid, it's typically valued higher because you have no problem buying and selling it. You can exit at any time. So this notion of being worth more because it's liquid has added a ton of value to the art and collectibles market as it transitions from a physical era to a digital era called NFTs. So that is one of the first key aspects, what makes NFTs valuable. The analogy that we seek is from the art and collectibles market and also the transition from the physical to the digital realm, which we've seen a number of times. So history is repeating here with respect to aesthetics, rarity, and prominence. On to the next one. So income generating potential. The most oft-cited misconception that I hear about NFTs, people say, oh, they're speculative because they don't generate cash flows. That could not be further from the truth. My NFTs have generated way more yield, way more dividends than I've ever received on any stock or any equity investment. It's actually pretty exceptional. And people, like, if I'm explaining NFTs as an investable asset class, the distributions that we receive via minting access, airdrops, and all these other benefits of owning the NFT that generate income and yield in my NFT portfolio, that is the most important one that investors need to realize, is that NFTs can represent tremendous income generating potential. Now here I have an example of a Bored Ape Yacht Club NFT, as we see at the top. Now these are fairly expensive, but over the past year, say last year, if you bought one for $10,000, you've collected more than $100,000 in special dividends, what we refer to as special dividends, either their airdrops, their minting access, token claims, things of that nature. And if you look at the bottom 5 NFTs, those are a sample of some of the distributions that we have received for owning a Bored Ape NFT. And all of those NFT distributions represent a yield, a triple-digit yield on this NFT that has added up to more than $100,000 over the past year. So a tremendous amount of income generating potential, not only via the direct airdrops, minting access, and one that just happened this morning was the Ape token that Bored Ape Yacht Club members were airdropped, and it's worth a significant amount of dollars. For example, this ape right here would have received an additional roughly $120,000. Sorry, scratch that. $130,000 of additional dollars for owning a Bored Ape, Mute Ape, and a Bored Ape Kennel Club, this dog here. So that's another significant distribution that has boosted the last 12 months annual return for owning a Bored Ape. The dividends collected have been roughly $230,000, and that NFT is still worth hundreds of thousands of dollars. So probably $500,000 in value for owning this NFT over the past year. Half of that, which has been the yield. Another important aspect is with owning an NFT, you actually generally own that intellectual property, which opens you up for many income generating opportunities, including licensing. And that is part of the NFT segment, the asset class that is just starting to come to fruition. Others include staking and lending. So a Bored Ape, you'll be able to stake it to generate additional yield. So I cannot stress this enough. The income generating potential with NFTs is just absolutely tremendous, and multiples of that you can experience in stocks or bonds. It is something that investors really need to take a deep dive into understanding, because many investors are searching yield these days in a widely inflationary environment where real interest rates are about -7%. We're looking for yield anywhere we can. So the yield, if we can generate triple-digit yields in NFTs, that is something to consider. So the income generating potential and the utility of owning an NFT is the most underestimated value driver within the NFTs. And it's an element that we derive from traditional asset analysis, stocks and bonds. We view value of equities and fixed income by their underlying cash flows, and we can do the same for NFTs by looking at the dividends or special distributions, the yields that they do provide. So the second aspect making NFTs valuable are their special dividends and the accompanying yield that they provide, and cash on cash yields that can hit triple-digit rates. So just absolutely significant. The last key value driver is social proof, membership, and credibility. So if we look at the pictures on this slide, you'll see the Twitter profiles of a number of well-followed celebrities. Jimmy Fallon and Eminem, they both have Bored Ape Yacht Club NFTs, and they both have tens of millions of followers. So this provides free advertising to anyone with a collection that drives the value of all NFTs within that collection. On the right, we have tennis star Serena Williams and rap star Jay-Z flaunting their CryptoPunk NFTs. They also have tens of millions of followers and massive social clout. And when they post these, they're advertising everyone's CryptoPunks, everyone's NFTs, and driving value by marketing the entire collection with their own NFT. And these celebrities are acquiring these NFTs six-figure values, and they're marketing them basically to their massive audiences in the hundreds of millions, promoting all the NFTs, which drives value of the brand, and therefore driving value of any of the NFTs held by any investor. So it's basically free advertising, the building of that social proof, the building of that credibility by massive influencers, celebrities, athletes, etc. So let's speak about the metaverse. Now, what the metaverse represents are digital worlds that we're slowly transitioning to. As humans, we are transitioning from a physical realm to a digital realm. We see it every day as we spend more and more time on our phones, on our computers. 3D graphics and virtual worlds are becoming more popular. And there's traditional ways of establishing social proof in the physical realm, whether it's having a Harvard MBA, whether it's driving a Mercedes-Benz. There's these certain physical attributes that people like to effectively show off or flaunt to help establish their credibility within the market. Now, the default way of establishing credibility in the metaverse within Web3 is to have an NFT. Your NFT is your avatar in the metaverse, represents your status in the metaverse. It's equivalent to the digital version of a Harvard MBA. It's equivalent to the digital version of a Lamborghini, where you can go online, have instant credibility and an instant network within the metaverse, within Web3. So when you own a CryptoPunk, you are in the same exclusive club as Jay-Z, Serena Williams. When you own a Bored Ape, you're in the same exclusive club as Jimmy Fallon and Eminem. You can envision that as perhaps being in the most expensive country club in the country, or having that digital MBA, that digital Harvard MBA, that digital Lamborghini, you get that in the metaverse through ownership of an NFT. So that's the last key value driver of holding an NFT. It's just a social proof, the membership, and the credibility that it provides. So basically, NFTs, they are a cultural phenomenon, whether you like it or not. It's having tremendous growth, similar to Bitcoin in 2013, which I'm going to get into. But at the end of the day, NFTs confer not only wealth and status, but also social influence within the metaverse and within Web3, which are both growing significantly. So let's talk about the liquidity and the establishment of this asset class. So this chart shows NFT trading volume in millions of dollars on OpenSea, which is currently the largest NFT exchange. So as you can see in this bar chart, you had an explosion in August 2021, which really, to me, as an institutional investor, represents the birth of the asset class. So this is an asset class that really started in Q3 of 2021, so it's not even a year old. And currently, the monthly liquidity within NFTs on the most popular trading venue is nearly $5 billion. And NFT, the entire market, is now a $40 billion market, similar to where Bitcoin was back in 2013. So I'm going to keep referring to that analogy because I think it is the correct analogy and one of the best ways to think of the NFT opportunity currently. So let's get into that in more detail. Like I said before, it is still very early innings for NFTs. And this chart here shows the Google interest over time. So the amount of Google searches for both NFTs and Bitcoin. If we stress that Bitcoin analogy further, we can see that the Google searches or the consumer interest in NFTs precisely matches that of Bitcoin in 2013. So in my opinion, Web3 in 2022 is analogous to Bitcoin in 2013 and the internet, i.e. Web 1, in 1992. And clearly, the way to play Web3 is not through the equities, because the equities don't own Web3. Like I said before, the token holders own Web3. The users own Web3. And the best way to gain exposure and to capitalize on the future growth in Web3 is through ownership of the tokens, i.e. the NFTs. So the most important thing to remember, current interest in NFTs is equivalent to Bitcoin in 2013. Further stressing the growth in the NFT market, here's a chart of NFT users on OpenSea. It's just rocketed from barely nothing 2 years ago to now nearly 1.5 million users, which has basically doubled over the past month. So the growth here is still tremendous, but the amount of users still only equals or rivals the users of Bitcoin in 2013. Currently, Bitcoin has more than 220 million cryptocurrency users. So while there's a significant hockey stick growth in NFTs, as you can see, as shown in this chart, I think there's still potential 10x to 100x growth coming in the future. So NFTs, while the chart looks crazy, it's still very small and, in my opinion, poised to become a big market. Taking this Bitcoin analogy further, on the left is a chart of totalblockchain.com wallets, which are about 100 million currently. And if we take that analogy of equal amount of users, NFT adoption is equivalent to where Bitcoin was back in 2013. Now, comparing that to the Bitcoin price back in 2013, you can see where the arrow points to, and you can see the corresponding price action over the next 9 years. If that occurs for NFT holders, that would obviously be a tremendous return. But in any event, myself as an investor, if I know this is a potential scenario, I sure as hell want exposure to that. Even if it is risky, the way that we deal with risk is by position sizing. If I can have a 1% position in my portfolio or 0.5% position in my portfolio, that has 10x upside with reasonable probability. Granted, it could go to zero, but if it does go up 10x, 1% position, that turns into 10%. That is material. But if a 1% position declines 80, 90%, not the end of the world, because I still have 99% of my portfolio, which is fine. So Bitcoin in 2013 went up 100x. If my idea, my thesis that NFT adoption is analogous to Bitcoin in 2013, then it does have that 100x potential. And we have seen that before. As I said, history doesn't repeat, but it sure does rhyme. And I think this could rhyme as well. It's early innings for the NFT asset class. What this chart shows on slide 14 is that it's still retail dominated. It's incredibly inefficient. The smart money, the so-called smart money, has not even entered this asset class yet. It's still small money retail, and these are the investors driving this market. Invest believe when institutional investors enter the market, where does the price go? They bring a lot of capital, and the supply of blue chips is not increasing. So when capital comes into the space, Econ 101 shows increasing demand with a set supply causes prices to go up. So we want to be positioned before the institutional investors come in. Now, Accelerate, as the first institutional investor allocating to the space, it's pretty exciting to be. But when the large, billion-dollar plus funds start coming in, hedge funds, pension funds, endowments, granted, that will still take 5 to 10 years, as we saw in cryptocurrency. But in my opinion, it will happen, or it is likely. I can never say will, because that implies certainty, but I say it is likely to happen. So this slide shows historical performance of some popular NFT collections. And what I wanted to stress is that January 2022 was a real tough market for risk assets. We had the NASDAQ tanking, we had cryptocurrencies tanking, but we had NFTs absolutely mooning. Huge rally, many NFT collections doubling over January. So that is the diversification benefit of this alternative asset class that I've been stressing. This is an asset class that is being driven by different economic characteristics than other alternative asset classes and other traditional asset classes. Hence, the diversification benefit of including this within one's portfolio. And you can see me mention the Accelerate NFT Fund that we are going to launch. So I just wanted to, prior to getting to questions, quickly run through what we offer at Accelerate. We're launching our NFT Fund. We want to provide exposure, this upside potential to Web3. And we don't do that, remember, we don't do that through equities. We do that through NFTs because that's where the value, the vast majority of the value of the growth in Web3 will accrue to the token holders, not equity holders. So keep that in mind. Web3 is leaving the Facebooks, the Googles in the dust. So I should call Facebook Meta, but Meta will not own the metaverse. NFTs will own the metaverse. And gaining exposures individually through NFTs can be prohibitive for a number of reasons. So number one, cost. I mean, buying a Bored Ape or a CryptoPunk can cost hundreds of thousands of dollars. So it's a lot easier to gain scale and diversification through a widely diversified portfolio that you can access with a much smaller check size. Fees, transaction fees via gas on the Ethereum blockchain can be prohibitively expensive for individual NFT traders. There's a ton of efficiencies and economies of scale within a fund. Then there's just access. Trading NFTs is tremendously complex, can be very technologically challenging to not just trade them and trade them intelligently, i.e. getting them for good prices, but also storing them securely. I see hacks, and they're mostly mistakes by the NFT holder, occur all the time. So it's important to have institutional caliber storage methodologies that keep NFTs safe. And that's what institutional investors and a fund can provide. So Accelerate NFT Fund makes diversified NFT investing simple, straightforward, and secure. So the assets that we focus on are the blue chips. You know, the Dow Jones Industrial Average of the NFT space. We're looking to gain exposure to the widely accepted, most globally recognized, most liquid NFT collections, the CryptoPunks, the Bored Apes, the Meebits, the CloneXs, the VFriends, the Cool Cats, the World of Women, all those NFTs we want to own. We want to be the Dow Jones Industrial Average of the NFT space. They're the most liquid, they're the most highly valued, and you know, in a risky space, they do present the least amount of risk on a relative basis and provide the most staying power, in my opinion, the most upside potential. So that's where our focus lies, in the blue chip NFT collections. Here is an example of the market capitalization of these blue chips, roughly $10 billion and seemingly growing every day, but they're highly liquid and they're worth you know, a tremendous amount of value, similar to where Bitcoin was in 2013, carrying that analogy once again. So here's some characteristics of our Accelerate NFT Fund. If you're interested, be sure to reach out. Here's how it works. We manage the limited partnership for our clients, and the LP goes and will buy NFTs, store them within a third-party institutional custodian. Some idea of if we're able to launch it as a public fund in the future, which may be our goal. GBTC did trade at a large premium to NAV for many, many years, and we believe that could be the same as a public NFT fund. So I did want to touch on risks of NFT investing. They're obviously highly speculative, a brand new asset class, incredibly volatile, and risk going to zero. In fact, I believe 99% of NFTs will be worthless. So you got to know what you're doing in this space. You've got to diversify and focus on collections that are going to withstand the test of time. So NFTs represent a nascent niche asset class, currently a $40 billion asset class. There's no guarantee that they'll continue their current liquidity and that they'll continue to be investable. They are denominated in Ether, and Ether is highly speculative, very volatile, and if Ether goes away, then these NFTs will be worthless. NFTs wallets can be hacked or stolen, so it's important to know what you're doing. Be very careful, and if you don't know what you're doing, get someone to do it for you, someone who has access to institutional caliber, third-party cold storage. So the fund that we are launching will have a risk classification very high, and if you're planning on allocating to the NFT asset class, don't risk more than you can afford to lose. I see too many who are overexposed in this space. Brief overview of who we are. I'm an avid NFT collector. I entered the space in March of 2021, so I've been trading in it for over a year. And I think my skill set is unique in that I have roughly 15 years of institutional alternative portfolio management in the hedge fund space. Previously won number one hedge fund in Canada. And I combine that with significant amount of experience in the NFT space. So there's not a lot of institutional allocators that do have expertise in NFTs. So I believe I have a unique blend, not just crypto, but also NFTs and traditional asset classes. So I also launched the first Bitcoin fund in Canada in 2017, launched the first crypto-focused blank check company 2018, currently the chairman of Bitcoin Well. And I do run four hedge fund ETFs on the TSX and one crypto ETF on the TSX, which are outlined here. So we run the first SPAC arbitrage ETF, ticker ARB. We run a long short equity ETF, ticker HEDGE. That is true portfolio hedge. That's negatively been negatively correlated for the equity index. We do run a buffered index, ATSX, that has a 0% management fee. We also run Canada's first alternatives portfolio solution, 1C, which is a broad allocation to 10 alternative investment strategies, 6 alternative asset classes. And we do run ABTC, which is the eco-friendly Bitcoin ETF. So if you like exposure to Bitcoin, please consider ABTC. We have a team with over 6 decades combined track record in alternative investments. We have a ton of experience in crypto, and we're pioneers in the space. coming out with the first NFT fund, and we offer the first Bitcoin fund in Canada. And we are enthusiasts. We love the space. We're super keen on it. We think it has a ton of upside potential. We're excited to offer this exposure to investors through a new NFT fund. Here is an overview of our investment team, our key executives. There's currently 12 of us at Accelerate, an outline of our awards, so many Canadian hedge fund awards, and a number of global alternative investment management awards from Preqin and Barclay Hedge. Some contact information. For now, I will open up the webinar to the questions. So if you do have any, I will take those. All right, getting to the chat. Please add more if you want. So the first one mentioned that ApeCoin is at $8 right now. So what SM is mentioning here, ApeCoin, that was today's airdrop to Bored Ape Yacht Club NFT holders. So each Bored Ape Yacht Club got 10,000, roughly 10,000 ape coins, currently worth $80,000. And each Mutant Ape got approximately 2,000 ape coins. So that's worth 16,000 US dollars. So it's a awesome day to be a Bored Ape Yacht Club NFT holder because you just got a good chunk of change in your pocket. And it just exemplifies that yield and dividend special distributions that we enjoy as NFT holders. And at an $8 price, the ApeCoin token has an aggregate market capitalization of $8 billion. You don't see that come across often. So if you're new to the space, it's certainly worth reading up on because it's not going away. It's only gaining momentum. So I think it's a great time to certainly get educated on the space. So another one, just like many coins from 2013 went to zero, and he's right about that. A ton of scams, ton of junk out there. We are definitely seeing that in the NFT space. How do you like to identify the Bitcoin of NFTs? Great question. So my first word of advice is stay away from new mints, especially from teams who are not doxed, i.e. have not, given their public information. I mean, would you give thousands of dollars to some random person on the internet? I still am shocked by those minting NFTs. I view trading in new mints as kind of the penny stocks. And I think that nearly all of them will be worthless. There's so many rug pulls out there, so many scams and frauds that people are getting caught up in. So my first word of advice is never mint unless it's from a legitimate team that has a track record of success, is fully doxed, i.e. you can do due diligence on them, and they're just not going to run away with the money. How do we identify the Bitcoin of NFTs? So these are the ones that are globally recognized, that have massive communities, and that are generating value for their owners. And you typically see that. I think that's pretty obvious. Yuga Labs is a leader. They're basically, the Bitcoin of NFTs. So they own Bored Ape Yacht Club and the Mutant Apes, Bored Ape Kennel Club, CryptoPunks, and Meebit. So those are clearly the leaders. I think it'll maintain their leadership, and those are the ones to focus on, and definitely get some mid-cap and small-cap exposure as well. You can see that kind of in the top 50 trading volume. So important to focus on those that have already established themselves in the market and already proven out a track record of success to NFT holders. What is the NFT picking strategy? I think it's a mix of quantitative in that we're looking at market capitalizations, we're looking at liquidity, we're looking at time in the market, we're looking at yield and things of that nature, and discretionary. So I think it's a combination of the two, the so-called quantamental strategy. Quantitative, supported by fundamental due diligence required in the NFT market. We'll be custodian for our NFTs yet. Stay tuned. We're just finalizing that. We're in discussions with a number of third parties, so we're excited to be able to announce that shortly. And I believe another question here. Within a collection, how will pick between two different Bored Apes? Great question. So we look upon a number of things, obviously with what's happening now. you want to look to see if they've claimed the ape token or not, i.e. has the ape gone ex-dividend? That's an important thing to consider right now over the next 90 days as this ape token claim happens over the next 3 months. So has the ape token been claimed or not? Because that is a significant portion of value. We look at obviously what the floor value is, what the rarity attributes are, and certain things like that. So we'll generally stick near the floor. Our goal is to be within 10% of the current floor, and top 50% rarity trades if possible. So it's a quantitative process with some quantamental mixed into it. Next question. How rampant is wash trading in the NFT space? That is certainly a significant concern, and it's just straight up obvious sometimes that there is wash trading. Luckily, we have the blockchain to analyze, but unluckily, it's not a regulated space yet. So wash trading is pretty prevalent, especially on LooksRare when they're incentivizing wash trades. So it's important to kind of do your due diligence into the analysis of the liquidity and make sure that they're bona fide, legitimate trades between a buyer and a seller and not someone just painting the tape. I think one thing that a headwind to wash trading are the accompanying fees with trading in NFTs. There's not only the gas fee, but there's the percent fee for the exchange, and there's a royalty to the NFT collection. So, if that cost is, 5 to 8%, and you're doing like $1 million wash trade, then that's going to be prohibitively expensive. So that's one thing that discourages wash trading, are the significant fees involved. So next question, easy to generate NFTs. Someone is on a mission to create thousands of NFT collections, simply trying to throw more crap on the digital wall, hoping to hit one of the ballpark, culturally speaking. It's just like, creating a ton of songs and seeing which one is going to be Billboard #1. It's creating a ton of paintings and seeing which one will become the next Picasso. It's creating a ton of Twitter accounts and which one will become the next Gary Vee. I mean, it's not so easy. These things are certainly difficult to generate the scale, social proof, and momentum that some of these premier collections have created. Like, it's not so easy to get Eminem to use your NFT as his avatar, right? So I think it's tremendously difficult. Certainly could be worthwhile trying if someone puts together a great team and focuses on it full time. But, it's like starting any new endeavor. If you want to create the next Facebook, the next Google, that is a gargantuan task. And I think creating a blue chip NFT collection is no different. Compared to Bitcoin, NFTs represent unlimited supply of digital artworks. How does this relate to physical art scarcity? I disagree with that. There's tens of thousands of physical artworks created every day, and there's an unlimited supply of physical artworks. There's literally, I could create one in the next 30 seconds here. Physical artwork is significantly easier to create than an NFT, although I can create an NFT in about 2 minutes. And so they're both relatively easy. The key is making it valuable, right? And so we went through the key value drivers of NFTs, and making an artwork or a collectible value is same thing as well. You want to keep the collection limited in nature. And if you look at like Damien Hirst, for example, he's one of the most popular and best-selling living artists today. His artworks have sold for tens of millions of dollars. He came out with the NFT collection, and they're generally trading. Each one is at around 4 ETH last time I checked, which call it is tens of thousands of dollars. And he did that by creating a unique artwork and keeping it limited in nature. Certainly, the amount of physical artworks is unlimited. The amount of cryptocurrencies is unlimited. The amount of NFTs is unlimited. However, the amount of Damien Hirst artworks is limited. The amount of Bitcoin out there is limited, and the amount of CryptoPunks out there is limited. So when talking about the supply dynamics, it's important that we narrow it down to the supply of blue chip NFTs. Similar analogy would be the supply of Bitcoin. Similar analogy would be the supply of Damien Hirst artworks. That's the mental model in which we should look at the supply dynamic. It's only 10,000 CryptoPunks. They're not creating any more. All right, next question. I appreciate the question. There's some good ones. What is the risk to investors if certain NFTs are deemed securities by the NFTs? NFTs with tokens with certain characteristics. That's a great question. And so our guidance, at least from the Canadian regulators, is if you wholly own an NFT, and you got to remember an NFT is a non-fungible token, i.e. it's a wholly controlled asset. It's similar to owning a whole business. So like a private equity firm, if you wholly own a business, that's not a security, that's holding an entire asset, similar to owning a piece of real estate. So that's what we are relying on certain NFT collections that aren't securities. However, when it comes to securitizing, i.e. fractionalizing NFTs, those instantly become securities. So when trading these music tokens or fractionalized NFTs, be extremely careful, because I believe these are likely to be deemed securities and therefore can be classified as unregistered securities offerings. So be very careful of that. I got a question by email. It said, why would someone allocate to NFTs? Main point, well, two main points: high upside potential. I think the best analogy is early stage venture capital or Bitcoin in 2013. Number two is diversification benefits. As we discussed, the correlations are as close to zero as you can get, because the price performance is driven by different economic characteristics, different economic drivers. NFTs have rallied double digits year to date, while risk assets have fallen, while the NASDAQ is down double digits. The NASDAQ is in bear markets. Tech stocks have been smoked. NFTs have rocketed. So that lack of correlation being driven by different economic drivers, to me, as an allocator, represents, hey, this is a true alternative asset class that provides that diversification benefit. And that's what we want to capitalize here. Diversification is the most important tool that investors have, and NFTs can provide that. Okay, so how would this be taxed? So taxed as capital, like any asset similar to real estate, cryptocurrency. I believe the tax authorities view NFTs as capital property. However, I am not a tax expert, so it's important that you go see a tax expert to get professional tax advice. That is only what I think, how they may be taxed. Position sizing, more cap weight versus equal weight. Yes, we are focused on cap weighting. Similar to, say, the S&P 500, we want to be more heavily weighted in the larger, more liquid asset classes, just to provide that sort of broad-based NFT asset class exposure. That's our main goal, and providing to investors is just gaining that broad-based NFT exposure, and you do that by cap weighting. I see no more questions in the webinar. Thanks everyone for joining. I really enjoyed it. Super keen on this NFT space. Thank you for all the questions. Hope you have a wonderful day. Bye everybody.